Lo and behold, a show where stocks are not getting absolutely slaughtered. Glad to be with everybody here on the 14th of April, where, I don't know, it feels like we're coming up on halfway through the year somehow. We've got a great show lined up today. Ryan McKeveny is with me. He's the managing director of mortgage and real estate services at Zelman Associates. Good to see you, Ryan.
Good to be here, Greg. Thanks for having me.
Hey, you caught my eye, my friend, not just because you're one of the more handsome people in the mortgage industry, but because you were on stage at Housing Wire, the economic summit in Dallas, Texas. I guess that's about 5 weeks ago. Everything's really flying right now, and you really impressed me. And you know your stuff. You're tasked with knowing a lot about the real estate and mortgage market, and in your work at the firm. Why don't you real quickly, before we get into so many topics, because we're really going to cover a wide gamut today. I know people are going to really love where we go with this. Tell us what you do.
Yeah, absolutely. So, in Dallas, gosh, it feels like a lifetime ago, but that was fun and a really great event they put together. So we at Zelman, we're a housing research firm. Everything we analyze is related to the housing market. As Greg mentioned, my specific role is within the mortgage and real estate service space. So pretty much anything that touches the mortgage origination market, as well as the existing home sale market. As a company, we do a lot of forecasting across pretty much every major housing data point you would expect us to. So forecasting existing home sales, new home sales, housing starts, home prices, go down the list. We do also, we're not going to talk about stocks per se today, but we are an equity research firm. So we do follow the stocks of housing related companies. We play an interesting role. We sit in the seat that's a bit economist on one hand, a bit investment research on the other hand. But all we do every day, just like you, Greg, is dig deep into the housing market and try to get a sense of what's going on.
Well, this has been on the board now, this interview, for over 3 weeks. And wow, so much has happened between the time you said yes and this moment we're in right now with the tariffs and the turmoil and the 10-year note. So let's just start with the 10-year Treasury and what you believe it is signaling.
Gosh, it's signaling volatility and uncertainty. I mean, if we go back a week and a half to Friday following, I guess it would be Friday, April 4th, the initial reaction was a bit what we would have suspected. It's okay, these tariffs are kind of viewed as bigger and larger than anyone had anticipated, spooking the markets. Initially, you saw yields move lower. That type of reaction felt normal, expected. And I think you could take a step back and say, from a housing or mortgage perspective, there's a lot of uncertainty, but at least rates are coming in a little bit. And that gives us a bit of a, some good signs in a time that's very uncertain. Fast forward the following week and you see yields jump at a pretty significant rate. My sense, I think there's still a lot of debate as to why exactly and what are the causes. Whether it's hedge funds liquidating certain treasury related trades, whether it's foreign owners of treasuries starting to sell. Like, there's a lot of debate around what's going on. I think the thing we look at most closely is twofold when it comes to rates, starting with the 10-year. It's kind of, the 10-year alone is very important, as everyone watching this knows. The spread between mortgage rates and the 10-year is also incredibly important. That's still very wide versus history. So
historically, it's at what, 160, 170, somewhere in that range?
That's
right. What is it today?
We're somewhere around 240 basis points today. So, let's just say 75, 85 basis points wider than normal. A few interesting comments I'd make with that. One, even though that's still very wide compared to history, it peaked out at around 300 basis points in the middle of 2023. So we have seen mortgage spreads compress. It's started to go in the right direction. But when you get a period like last week and just volatility across the board spikes, you do see spreads typically initially widen. So it's hard to diagnose in the here and now. We could have some additional spread widening in the near term, given that volatility. We look at, I'm sure a lot of people who follow the stock market, they hear people talking about the VIX, right? In the fixed income market, there's an index called the MOVE index, and it measures the implied volatility of treasury yields. There's a pretty decent correlation over time between the MOVE index and mortgage spreads, meaning when volatility comes down, spreads compress and vice versa. So that's what we're watching, here and now is this incremental volatility going to cause spreads to re-widen, i.e. bad for mortgage rates? Or do we get a bit of a settling down and could actually see some improvement?
Well, if the sell-off in bonds is related to foreign entities who hold a tremendous amount of our debt, what does that say? What does that portend for the future if that's what's happening?
If that's happening, I think it just adds to the spread widening. I think there's also, as much as there's foreign countries that own treasuries, there's foreign countries that own MBS, right? That own agency MBS.
I think it's like 1.2 trillion, right? 15% of the market share, something like that.
I think that's about right. So, if you get a flush of selling, I think the general dynamic in the here and now is that can cause spreads, that can cause rates to move higher, kind of move in the wrong direction from how we would want things to move. And I think any mortgage company would want things to move. With that said, that could be a temporary thing, right? There is a finite amount. It's a lot, but there is a finite amount. So I think that's a bit of what the market's trying to digest with the whole concept of tariffs and what it means for rates, what it means for the equity markets. How much of this is just a kind of near-term flush of uncertainty, we all need to figure it out and then we can settle down? Or is this like the beginning of something broader where uncertainty is paramount for the next 2 years or something?
No, not just uncertainty. I mean, there's some people that are saying, oh my goodness, is the dollar no longer the reserve currency? That's a big idea. Like, first of all, where do you stand on that? And secondly, if we ever got to a period of time where it's no longer that, what would that spell for the U.S. economy?
So I would say at a high level, the topic of the dollar is outside of our specific expertise. So my high level personal comment would be, to the extent the dollar becomes less so of the world's reserve currency, my presumption would be that would be a very negative scenario. But that's just me speaking. We don't take a direct view on the dollar supremacy. But I think it's fair to say if that receded in its prominence today, it would not be a great thing.
Well, you do take a direct position on builder business, and you spoke about that, and that's what really made these ears of mine perk up at Housing Wire's Economic Summit, because you talked about the fact that you felt like the new starts and new construction was here to stay. Historically, I don't have the exact numbers, but I believe that new construction accounted for, 10% of available listings, and it crept all the way up to 30, 35%. I've not heard any updated numbers. So if you have those, please tell us and give us a historic perspective of where it was, where it is. But more importantly, and what really caught my eyes, is that you feel like that trend is here to stay.
Yeah, so a couple of points I'd make. The way you framed the question is interesting, and I think the way it gets framed a lot, it's the new home share of inventory, which is somewhere in the 30% range. For whatever reason, people don't talk about the actual market share of transactions, right? So new homes as a percent of sales, like actual homes that sell and close, it's in the 15% range. It's at the highest level since 2006. So it has been creeping higher. The last few years, there has been a pretty meaningful market share shift to the new home market away from the existing home market. So the existing home market is the reciprocal, right? It's the other 85% of the pie. But on the margin, you have seen the new home side outperform. One kind of change that's been apparent year to date is the new home side of things has started to underperform the existing home market after a couple years of very strong outperformance. So the question is, why was the new home market outperforming, and maybe what's changed? I'd say in terms of why the new home market was outperforming, one, from an inventory perspective, you could make the case that there are certain submarkets that had depressed levels of inventory. The builders could bring supply. If you're bringing supply into a supply constrained market, you could sell those homes. More important than that, the amount of mortgage rate buydowns and forward commitments that the builders are partnering with mortgage companies on has been through the roof. So pretty much across all the large private and public builders, you're talking about mortgage rate buydowns. If the prevailing mortgage rate today, if I was to go in the market and buy a home, my mortgage company is probably going to quote me somewhere around 7%. You could correct me if I'm off on that, Greg, but let's just say 7%.
No, you nailed it. Yeah, somewhere in that range.
If I walk into a new home community in Phoenix and start talking to a salesperson, as I get down that funnel, I'm going to find out that if it's not blatantly advertised on their website and on the, right in the sales office, I'm going to quickly find out that they're buying my rate down to, let's say, 5%, a 200 basis point discount off that prevailing rate today. And they've been doing that, and they've been doing it very successfully. So I'd almost say in retrospect, the home building industry has found a bit of an affordability bridge. If we can get into the details behind affordability, but I think it's fair to say this, and I think everyone on the call will know, home buying affordability today is incredibly stretched. Home prices are high, interest rates are high, insurance costs, go down the list. The builders found a way to kind of bridge that gap. And the existing home market, you could, as a home seller, offer an incentive, a buy down. It's just nobody does that, right? Everyone's caring about their top dollar, whereas a builder is an economic seller. What do I need to do to move this inventory? So the piece, Greg, to get kind of a long-winded way back to the main point, when the builders have homes in the pipeline, they have what we would call spec inventory, a home that's already been built. They're going to do what they need to do to sell that home. They don't want, a finished home sitting there on the market. So they're going to cut the price. They're going to do these rate buy downs. They're going to find ways to move that. And the construction process can be quite long. If you start with the development of land and then into the community and then actually building the home, oftentimes, 12, 24, 36 months. So to some degree, the volume is coming one way or another. The question is at what price? So I do think what we're already seeing in the home building industry is margins are under pressure. Home prices are under pressure, not in the resale market, but in the new home market, particularly when you include these incentives. So it's a bit of a balancing act between the new and existing markets.
Well, at the same time, builders aren't building to lose money. So everybody's paying for this somehow. So whether there's a rate manipulation one way or another, certainly builders are not in business to lose. So yeah, you might get a 5% rate or a 5.5% rate, but then there's only pretty much one other place to have the excess and the profit, and that is in the cost to actually build the home, which is a great segue into tariffs and how you believe that may impact the housing market, right? You've got, steel and drywall coming from Mexico and Canada. And I'm so confused at this point as to what's delayed and what's not. I don't know if you've got the latest, but any light you can shed on that would be great.
So I think there are definitely many moving pieces as we all, learn new things by the day. We do a lot of survey work at our company. So we talk to private home builders, mortgage companies, you name it. When we talk to our private home building contacts, think of it as the C-suite of the biggest private builders in the country. The view we hear from them most consistently is they're expecting, if all the tariff cost increases go through, it's about a 4 to 6% increase in their cost to build. That's unrelated to the labor cost. It's unrelated to the land cost. It's just kind of the sticks and bricks, the actual materials going into the house.
I would think it'd be bigger. So is that not that big of a deal?
It's not that big of a deal. It's not a nothing. Nothing's ever a nothing. I do think that the high level looking in is, oh my God, tariffs must be so bad for the cost of residential housing. It's frankly not. Some of the components.
Where is that? Is that based on a 10% tariff? Is that based on 25?
Yeah, well, so to take a step back, during the first Trump administration, when there was tariffs already starting, not to this extent, there was a lot of the start of some reshoring, the start of focusing on domestic manufacturing, domestic suppliers. With COVID, that accelerated for a lot of these home building companies. And this is not like a blanket statement across all industries within the US economy, but home builders specifically, they do source a lot from the US. There are some of these pre-existing relationships with Canada and Mexico where certain products do fall within tariffs that have already been in place, for instance, lumber. So it's not like an across the board new thing. I think there's some very specific categories. If you think of like appliances, those come from China. That's going to be a direct cost hit to somebody. And that's another interesting angle, is who actually takes the hit? Is it the consumer in the form of higher price? Is it the builder in terms of lower margins? Or is it the supplier to the builder?
It's probably a little bit. It's probably a little bit of everybody. Whoever can get what they can get.
I think that's right.
Isn't that how capitalism works?
I think
I don't know.
Our sense today is back to my comment about like the new home market underperforming a bit year to date, having a pretty sluggish spring selling season. The builders have no pricing power, right? If they did, they would not be buying down rates as much as they are. We actually published our home building survey today. The amount of base price reductions is going up. So builders have no pricing power. They are going to do everything in their power, in our view, to push back on the suppliers. So it could be the manufacturers, suppliers of these materials that take a lot of that cost increase on their own margin. Our view today is not a lot of it flows to the consumer per se. I think where the consumer comes into this is, what is all this doing to consumer confidence? We already talked a little about rates. That's like
that's in the consumer sentiments in the toilet. It's on its way to being flushed.
That's exactly right. So that's not great. I think the question about jobs, is this good or bad for U.S. jobs? Even if long-term it's good, in the short run, is there disruption?
But man, you're going in all these areas. I've got so much. I have to just interrupt.
I'll slow down.
No. Listen, you're touched. I've wanted to follow up 4 times just in the last minute and a half. So let's jump around for a minute here. Jobs. I think it was Barry Habib who spoke at the same conference that you did at Housing Wire, suggested that unemployment was much worse than what the numbers indicated. We're going to get into politics here a little bit, because, he kind of said it without saying it, that he felt like the previous administration fudged the numbers. We had all those downward revisions, massive revisions. So where do you expect unemployment to go? We don't even have the Doge cuts built in. We don't have any of the immigration stuff built in. Are you able to comment on what you believe is going to happen here in the next period of time? And what is that period of time where we might see unemployment go from a 4.2 to a 4.5, which is where Barry thought it would end up by the end of the year? 4.5, 4.6. Yeah,
and even if you look at, let's say, the Fed's own projections, their summary of economic projections, it's for some increase in the unemployment rate. Again, it's like a bit of an area that's beyond our, we don't exactly forecast ourselves the unemployment rate. I think the connection I would just make is, when it comes to housing, having a job is pretty preliminary to everything else, right? You're not buying a home if you don't have a job. You're not upgrading your home if you're, fearing that your job may be cut. Greg, you mentioned you sit in the DC area, so you probably see a lot of this more firsthand than me, who sits in Chicago. But even just the fear, right, the uncertainty, it can cause a bit of a pause. So I think the good news, I would say, is, big picture, job growth has continued, wage growth has continued. You see the typical signs that you would expect to correspond with that, i.e., home prices are still ticking higher in the existing home market, at least, not the new home market. If that changes, if we have a skyrocketing unemployment rate and tons of job losses, that is kind of our perception of the risk scenario in housing. Because even though we're at a pretty low level of transactions, in a recession, it can always get worse. So if we look back, and I know I'm going a slight different direction. This is good,
because I was gonna ask you. You're probably gonna tell me you can't comment, but I want to ask you anyway. Are we in a recession? Are we heading for a recession? Have you guys published an opinion on what percentage at this exact moment we are, as far as likelihood of a recession?
Our base case view does not embed a recession, but we do a lot of sensitivity is to think about what a recession would look like. 2 big categories: a housing-led recession, i.e. the Great Financial Crisis, the late 80s, early 90s, the S&L crisis. We would consider those housing-led recessions. Kind of housing was a very big component of why the economy went into recession. Non-housing-led slowdowns, think of the 2000s, the tech wreck, 1995. Those were not too bad for housing. in 1995 and 2000, you saw purchase origination. So people buying homes with mortgages were down 3% year over year in both of those periods. That's manageable, right? Like, we look back at the last couple of years and we see the purchase market's been down back-to-back years of about 20%. So the point is, could it go lower? Yes. Is there massive downside risk in the purchase market? Probably not. We're close to that baseline. The risk comes back to the home price side, because if we start having job losses, what does that mean? You have people that can't afford the home they're in. You have delinquencies go up eventually, and this could take a long time because it's a long process. Delinquencies go up, foreclosures go up. When you get forced sellers, that's when you get home price risk.
Well, let's talk about the data. What are you seeing on the data side from a delinquency standpoint? Because I know you're constantly looking at that stuff. Where's that? What direction is that headed in?
The big picture, the mortgage delinquency rate in total is pretty fine. It's below average, below
on the conventional, on the conforming side it is, but on the government side, aren't there some warning signs?
The warning signs are in the early stage government loans by far. So we do a conference every September, and we included a chart last September on early stage Ginnie Mae delinquencies. Each of the last several years have been incrementally worse than the year prior. Said differently, people are defaulting or going into delinquency faster than they typically do on Ginnie Mae product, which let's just call that's FHA, that's low down payment loans. DTIs are very high, higher than history, which makes sense, right? Interest rates are high, like just naturally you're going to see debt to income ratios higher in this environment. But that's definitely where the risk is. The risk is not somebody who bought a home in 2015 and is sitting on, massive home equity gains. The risk is, unfortunately, the consumer who was somewhat stretching to buy at peak home prices and peak rates over the last 24 months. The good news, there is good news. The subset of the overall mortgage market, that's still a pretty small component of things because there hasn't been much activity, right? We've been at such depressed levels of purchase volume. So there's a little silver lining, but there's definitely risk. The early stage delinquencies at Ginnie Mae are not definitely not going in the right direction.
Oh, something's not adding up. You have consumer sentiment in the trash.
Yeah.
You have consumer debt at all-time highs. Those two things alone, pretty soon people are going to have to start making decisions on their debt, which is mounting. And they'll start to ignore that. The credit card companies will go down. And then after that, the next thing you have to choose is food on your table or your mortgage in some instances, especially if employment gets worse. And, that's what I want to touch on because people talk about tariffs. Tell me if I'm getting this wrong. I just feel like there's a presumption that if there are tariffs, people will just pay whatever that tax is. Isn't there another scenario where people are like, you know what? Screw this. I'm just not going to pay for shit. Like I'm going to sit on my money. I'm going to sit at home. I'm not going to spend another $400 on a washing machine. I'm just going to deal with this old washing machine and I'm going to be more careful with how I spend my money. And if everybody starts to feel that way, or even 20% of society starts to feel that way, there's less money put into the system. People start to, isn't that the cycle? What kind of risk is that? To me, that's like, it's got to be a pretty big one.
Yeah, it's hard to put a probability, but it's kind of the stagflationary risk, right? It's the cost of everything getting more expensive, but demand is being destroyed at the same time. So
can you have stagflation if no one's spending?
Well,
what if people just decide to sit on their hands? What if I just decide I'm going to hoard my cash? I'm not going into treasuries. I'm not going out to restaurants. I'm not buying any new clothes, right? Can you still have stagflation if people aren't spending?
I think it's hard to take the extreme of nobody spending because like people will still spend. I think your point though is well taken, which is overall what happens to consumer spending if we recede in a significant way. You're trending toward that recessionary economic backdrop. Again, we don't base case, we're not there today, but it's part of the risk. It's people sit on their hands. Even in the last week, like I kind of mentioned, we do all these surveys, right? The last week across our team, we're on the phone with all of our executive contacts across the different sectors. Me, it's real estate brokers, mortgage companies, my colleagues on the home building or building products or home improvement side of things. The unknowns are very high, as you'd imagine. But the fear is very understandable. It's, if I have a buyer who's on the fence, they just became even more on the fence. If I have a buyer whose down payment was in equities, they just lost purchasing power. So I think there's a sense that in the near term, all of this could cause some pause, could cause some pullback. I think it's way too soon to see it in the data. But that's the concern.
Let me go to home prices for a minute.
Yeah.
So are we going to reach a point here anytime soon where they start to head south, where we're no longer expecting, I feel like the forecast, most of what I read, 3 to 5% increase, which is about 75% less than what it was when it was peaking a couple of years ago. Like it's not heading in the right direction there. What's it going to take? And then what is it? How would that impact the housing market if prices started to drop?
So a couple points I'd make there. Individual markets are already seeing home prices down. Many of these markets are in Florida and Texas. Not surprisingly, these are a lot of the markets where inventory is up significantly, both in terms of existing home inventory, but also in terms of where the builders are building. So price can go south. There are scenarios when you get the supply-demand imbalanced. On a national basis, as you alluded to, like if we take Case-Shiller, CoreLogic, FHFA, any of the main home price indices people focus on, you're up somewhere in the 3 or 4% year-over-year inflation right now, home price inflation. Our view is that decelerates. If we go into the recessionary scenario becoming the base case, home price risk rises a lot. Because that's that scenario I was getting to, where when you have the forced seller, where it's no longer discretionary, it's, I just lost my job, I need to sell my home. That's when it can spiral. So our base case view is price continues to move gradually higher after, as you know, very high rates of inflation in recent years on the home price side. But what does it take to cause home prices nationally to decline? I think that's the recessionary scenario where you have a lot of job losses.
Well, it also depends on bonds and rates, because if rates go down, that's going to serve as fertilizer for the demand, right? So, but if we're in an environment, where people start to lose their jobs, and for whatever reason the bond is not the flight to quality anymore, you think all bets are off. Who knows?
Yeah,
what happens?
It's hard to rank order, in real time, but consumer confidence, recession versus rates. History would suggest that the recession and the lack of confidence trumps rates. So if you go back post GFC, the US had some of the best affordability on record. Home prices reset massively, rates came down a ton. You had incredibly, on a monthly payment to income basis, affordability was effectively as good as it's ever been, and nobody was buying homes. So there's that confidence factor. So our general, this is a comment we always make, recession trumps rates. We don't disagree with the concept that if a recession causes rates to move lower, eventually, we'll call it a year out, 2 years out, that will probably be a good thing for housing. But in the here and now, the risk of job loss causes consumer confidence to weaken even further, adds risk to home prices, et cetera.
Let me bounce around to a couple other places here. Commercial real estate. I didn't prep you for a lot of these questions, so I'm hitting you from every direction. You're being a great sport. Commercial real estate. There are a lot of people that are on the hook with higher rates that can't refinance that debt. I mean, how much of a concern is the commercial real estate market to you and your firm? And what's the best case or base case scenario of how that might unfold, especially if rates stay in this area, much higher than what most coupons are?
Yeah, unfortunately, also one of those that's just outside my personal expertise. I'll try to give you an answer that somewhat touches on, the commercial side. So we have a team that does cover the multifamily apartment sector. What I would say there is a lot of supply. Rents have come down. The CPI data that we all see every month has not yet reflected the actual deceleration in rents. Hopefully it does. That could be a benefit to the inflation numbers we all see from the government. But the fundamentals in the multifamily space are, let's just say, not great. Occupancy is depressed. Rents are low. I think it's, the interesting thing from where I sit, where I mostly focus on the for sale and the mortgage market, I think the easy narrative we hear from the commercial or the multifamily side of things is, well, if rates are high and it's so unaffordable to buy a home, that must be good for rental. And what we've seen time and again is what's bad for sale is also bad for rental. If this period of high rates and unaffordable for sale homes was so good for multifamily, then why has rent decelerated so much? Why is occupancy at below average levels? Why is there so much supply that can't get filled up?
I mean, I feel like every commercial building I drive by, there's vacancies. I mean, in our corporate office in Linthicum, Maryland, you got an entire floor it's like 20,000 square feet, all decked out. Nobody wants it. In the building I'm sitting in right now in Northern Virginia, there are 2 or 3 offices.
And I think there's always the chatter of, hey, can you take this office park and convert it into multifamily? Or if you're in, the financial district of Manhattan, can you convert an old building from office to apartments?
But I heard an argument. I heard a think tank on this the other day, and my eyes were opened up to something I never thought about. Why would somebody want to live in a place where it's a ghost town, at 5 o'clock at night? You're in the midst of a bunch of commercial buildings, like.
Right.
I don't know. I mean, unless
the
it just
or the interior design of it is just not what you would expect from it. So where I was going with that is just that stuff is all on the margin. There's a narrative behind it. Oh, we could just convert this all to residential housing. Easier said than done from both.
Of course. Yeah. Let's get into the good stuff. You guys cover Rocket Mortgage, don't you?
We do.
Yeah. Well, is it public record whether you're a buy, hold, or sell on that? It must be.
We're so within our sector of the mortgage and real estate service industry, and maybe I'll just give the high level background here without going kind of name by name. Within each of our sectors, we rate stocks relative to each other. So we're always going to have some stocks rated at an outperform, some stocks at a neutral, and some at an underperform. And yes, I could say that Rocket is one of the stocks in our outperform, sectors within the mortgage and real estate service sector.
Was that pre-Redfin? And pre
all of that, the high level, and I would just say from the view of how we think about our sectors, as anyone listening can probably tell, from a macro housing perspective, like times are not great, right? We're at very low levels of volume. There's home price risk that we're talking about. Like the cyclical backdrop is very challenging. What we focus a lot on is which are the companies either growing on a secular basis or doing things to improve their business during these tough times, where we can look out 2 years, 5 years, 10 years and say, they're doing something that's going to improve their future. They're gaining share today. They're going to gain share tomorrow. So a lot of the relative ratings within our sector, you could summarize it as the companies doing well today, gaining share, doing the right things, investing in the business, generally skew toward that outperform category. The companies that are losing share left and right, those are the underperforms, where it's, they don't control their own destiny as much.
Are you able to comment on the position Rocket's in now, from the lens of your organization relative to before the acquisitions?
I would just say, as a general statement, I think there's always, question about, will there ever be a company or an entity that can truly have a bit of an end-to-end ecosystem, through the process? I think there's a few players that have the potential, but I think you need to do it right. You need to execute on the right pieces. It's always so much easier said than done. When you're a real estate brokerage saying, I'm going to attach mortgage, I'm going to do title insurance, I'm going to do it all, good luck. I hope you do, but nobody's proven a very high attach rates in these ancillary businesses.
Yeah. I mean, I hear people talk about how Rocket wants to be the next Apple, and I'm thinking to myself, well, Apple, the average purchase price is probably $600, if that. I don't know, 600 to a grand, right? You're talking about a house that's 400,000. You're putting your head down at night. You're raising kids. I don't know how anybody could think that they could be the Apple of mortgage. I mean, other than it just being a cute metaphor. Anyway, that's just a side note. Before I let you go, do you expect more consolidation? It's probably a layup question. You do, right?
For sure. Across the mortgage industry, across the residential brokerage industry. The comment I make to a lot of both these public companies we talk to and cover and private, contacts of ours, if not now, then when? right? We're at the trough of the cycle. It could get worse, as we're talking about, a recession makes things worse, but we're a lot closer to the trough than the peak. Valuations generally for private companies, let's say, just to avoid the public company stuff, are not high. So if you have the capital, which is debatable, most people don't, I would say generally, I don't know, you'd much rather be acquisitive today in 2025 than you would at the peak in 2020 or 2021.
Yeah.
So
do you have your ear to the ground on private equity money and the appetite it has for the mortgage space at this time? Is that something that you follow?
No, not
Okay.
not too specifically.
All right, that's good. You made a comment during our conversation. This is one of the notes. You said that we're off to a sluggish spring start. That's interesting to me. Do you want to share what's behind that comment? I mean, do you have data to support it?
Yeah, and I kind of talked about the home building aspect of things, right? So new homes have been gaining share, and more recently they've been underperforming the existing home market. If we just think of existing home sales in total, we're kind of hovering just north of 4 million, which as a percent of households, how we think about it to kind of normalize the absolute number, we're basically at recessionary lows. Not too dissimilar from the GFC, not too dissimilar from the early 90s. So the comment I would make is to say the spring is off to a relatively slow start, that's more applicable to the new home market, where even with those heavy incentives, even with the base price cuts, they're not hitting the absorptions they want to. The resale market is doing a touch better, but certainly not, not some like great start to the year by any stretch of the imagination. Our general view going forward is we do start to see growth. I think maybe one important comment I'd like to leave the audience: affordability matters so much. When affordability is stretched but improving, so let's say in a world a year from now, if rates are somewhat lower, that probably means affordability is somewhat better. It's still stretched in absolute terms, but it's getting better. That's when you tend to see the strongest growth in home sales. That's when you see the strongest growth in purchase originations. So there is a scenario at which you get a pretty good, snapback from a growth perspective. Even if the absolute levels of activity still feel pretty depressed, you start growing, but you do need some better affordability to kind of get to that point.
I know you cover real estate too. I'm not sure to what degree. Obviously, I'm in the mortgage business, but Compass and what they're trying to do in gaining market share, and is it PPC? The PPC, PC, it's PPC, I think. The Zillow just CCP, right? Zillow or CPP.
CCP.
All right. Well, all right. Anyway, if only I could add to it. There's just too many. There are too many acronyms flying around out there.
Yeah,
I think Zillow just kind of struck back and said that they're going to do something to keep listings off of their homepage if this happens and that happens. What's your opinion on what's going on the real estate side? You care to render one and where that's headed?
I would say, the consumer wins, consumer transparency, disclosure. If something proves to be good for the consumer, that is the way the industry will go. If it proves not to be good for the consumer, it'll go the other way. So I think it's a big point of debate. There's tons and tons of rhetoric. Base case, I would say not a whole lot is actually changing, but there has been a push by some to move more toward private listings, as opposed to more publicly available listings. And there's a lot of philosophical debate on which route is better for the homeowner and the seller. I would just say where we come out is the consumer is the one who's going to decide. If Zillow is setting a policy, if you list in a private network, you're not going to show up on Zillow. For some sellers, they might say, great, I don't want to be on Zillow in the first place. You might have another seller who says to their agent, well, I'm not doing that because I do want to be on Zillow. Because millions.
Had a total brain fart. Clear cooperation policy, right?
Yeah, right.
CCP.
Clear cooperation policy.
Yeah. Do you expect more real estate and mortgage companies to form alliances and partner up?
I do, but most already have some form of relationship.
Got it.
Most builders have mortgage partners. Most real estate brokerages either own or have a JV structure. So there will be more gravitation. I think, to the comment earlier on just the philosophy behind Rocket doing what they're doing, whether companies can execute on the ambition is one thing, but everyone views it as, how do I be the one-stop shop? How do I provide more of those services to the customer? So I would generally expect more movement towards piecing it all together to be happening across the industry.
Yeah, I get the feeling from a comment you made a couple of minutes ago. It's one thing to feel like you're going to sell every single service. It's an entirely different thing to execute on that strategy. I mean, I think it's a big bet people are making that the consumer wants to be in one place for everything. I don't personally think that's going to happen, but I know there's a lot of bets being made by a lot smarter people. Have I asked you enough questions?
Gosh, I feel like we could go all day, but
I know. Are you hot in there? Is it, have I thrown too many at you? Are you sweating under the vest? What's going on over there?
got the air conditioning in one side, the fan blowing this way. I'm trying.
Oh, you're good.
Yeah.
Did I forget to ask you anything? You have any closing comments? How about how people can follow the work that you and your firm do?
Yeah, no, of course. ZelmanAssociates.com. As I mentioned throughout, we do a lot of survey work, a lot of partnership with folks in the industry. So anyone in the housing ecosystem out there that's not in touch with us, feel free to reach out, and we might be able to work together. So
I appreciate it, man. It's been great talking to you.
Thank you so much, Greg. It's really been nice to be here, and appreciate all the good questions.
Yeah, of course. Thank you, and we'll be in touch. Maybe we'll touch base again in a quarter or two to see where this thing is headed.
Sounds great.
All right, Ryan. Appreciate you. Take care. Have a good day. Hope everybody enjoys your week. The week of April 14th, next Monday, we have a real great guest, a star, and I'm not going to say anything yet. I'm going to wait. I'm going to wait a couple of days, but by Wednesday, you'll hear who's going to join me on Monday. Until then, have a great 48 hours. My thanks to Donna Chichevsky. She's the greatest. She's a legend. She's my good friend. She's pushing all the right buttons back there. Have a great week, everyone. We'll talk to you soon.